Hello everyone, it's Davide here and welcome back to Learning Finance. So in today's video guys, we are gonna look at fundamentals of the four biggest banks in US, okay? So banks stocks. So leave me a like if you find this video interesting, so you're gonna help me to grow the channel and subscribe to the channel. Let's begin. Alright guys, so here we are, J.P. Morgan and Chase, ticker symbol JPM, Bank of America, BAC, Citigroup, ticker symbol C, and Wells Fargo, WFC. Okay, so let's take a look. We have a lot of stuff to go through here. Now, let's start. Maximum drop. The maximum drop we have that in 2020, J.P. Morgan minus 45.46%, Bank of America minus 50%, Citigroup, the worst one, minus 62.36%, and Wells Fargo about a minus 60%, okay, 59.3. Let's take a look now because banks are a little bit different from others businesses in terms of fundamentals, okay? When we look at banks, we want to see high operating margins, okay? But we want to see also nice liquidity ratios and nice risk bumpers, okay? So I'm gonna show you later on what I mean by that. We want also see a nice diversification in revenues. We don't want that our bank is too much into loans and leasing, but is also doing something else, okay, like asset management and things like that. Because if we have a problem in crisis, the defaults are increasing and you are too much in the loan business, you're gonna get hit a lot, okay? So we want diversification from that point of view. But let's start and let's see what we have here. So in terms of revenue, we have JP Morgan, which is the biggest one. This one are quarterly data, okay? So revenue 28 billion for JP Morgan, 22.7 for Bank of America, Citigroup 20.7, and Wells Fargo 17.7. The interesting part here, operating margin. JP Morgan 26.14%. It is the winner. And the loser is Wells Fargo 18.24% for operating margin. Net margin after all the expenses, we have the Bank of America. It doesn't look bad, 17.61%. Okay. While JP Morgan 10.14 and really not good Wells Fargo, okay, just 3.69%. In terms of asset and liability ratios, they are very similar, okay, very similar. We can consider they are the same. All of them are around 1.10 as a ratio, okay. Return on assets. This is important. JP Morgan is the winner with 1%. Not good is Wells Fargo. Again, just 0.64%. Now we go through the real bank stuff, okay? Risk bumpers. Okay, now what do we look here? Here we look at the total loans and leases and the amount of allowances that those banks they have. What it means by that, allowances are the part that basically banks they put aside, and it is a bumper, okay? So if part of those loans they go in default, they already have cash aside to cover that loss, okay? So let's say, for example, if in the case of JP Morgan here, they are gonna have a 20 billion default in loans and they already have an allowance for loan loss of 25 billion, you're not gonna see a 20 billion loss in the balance sheet because this has already been accounted for. Okay, so they're gonna decrease the allowance, but the loss is not gonna be in the earnings. Okay, so that's how it is. This is a bumper. It's like something that helps you to not get hit too much in a single time. Okay, it's like something that you put aside for bad times, and that's what they have now. Total loans and leases, we have J.P. Morgan 1 trillion, okay? Bank of America 990 billion. Citigroup 700 billions, and Wells Fargo 965 billions. Allowances, we have 25 billions in case of JP Morgan, 17 for Bank of America, 20.8 for Citigroup, and 10.46 for Wells Fargo. Now this is important, okay? 2.50 for JP Morgan and 2.97 for Citigroup, which is the best in this case. Another very important risk ratio is this one, the CET1 ratio, which is from Basel III, okay? The minimum required is around 5%. It's a liquidity ratio. It's explaining us the liquidity risk of the bank. And the winner is JP Morgan with 12.30%. Worst one, again, Wells Fargo. But considering this ratio here, well, all of them are pretty nice. Now here we comes to something that is again interesting. It is what I was telling you before. Okay, we want that our banks is not too much focused on just loans. Okay, we want diversification. We want this diversification for two main reasons. The first reason, interest yield are to zero. And when you push interest yield to zero, banks are gonna earn less in loans, okay? Because interests are going down, so they earn less. And the second reason is because of the crisis, okay? So the likelihood of defaults is going up. So if you are exposed a lot on loans and leases, you are gonna be more dangerous, okay, in a dangerous position. So that's why we want that this one is not too high, okay. And let's see what we have. We have consumer assets, commercial assets, total loans and leases, and total earning assets, total financial assets. So what we really care is that this is not too high comparing to this, okay? And that's what this ratio is about. And here we can see that JP Morgan has 35.13% of loan to assets ratio. The winner is Citigroup in this case, 33.67%. But here we have a decent diversification, okay? Not too much on Wells Fargo, okay? 50%. It means that 50% of assets of Wells Fargo are loans and leases. Here, another very interesting part is to see how much of the total revenue is given by interest revenues, which are basically assets where interest is paid. Okay, so like loans and things like that. While non-interest revenues are revenues from assets where revenue is not paid. Usually it's like fees, or in case of JP Morgan, when they do the investment banking part, it's like, you know, they do a job, they do a deal, and on that deal they get paid some fees and things like that. So it's not interest based, it's a deal So in that deal, you have to work on that deal and you get paid for it, okay? Those are non-interest revenues. And again, in this case, we want a diversification from that, okay? So total revenue, let's see the percentage of total revenue which are from interest revenue, okay? So from the loan part and things like that. And here we can see that the winner is J.P. Morgan, okay, almost 50%, 51.11%, and the worst one is Wells Fargo, 63.85, almost 64%. It's a lot, okay, it's a lot. Means that if something bad happened in the loans and leasing and leases part of their business, they're gonna get hit very strongly, okay, in a strong way, because they depend a lot on those revenues, okay? So be careful in that. Wells Fargo is the worst of them all, okay, of those 4 banks. Let's take a look at the dividend. Well, the dividend, it's like a sort of a bonus for a stock, okay? If a stock pays a nice dividend, it's fine. And the important thing is that the payout ratio is not too high, especially in this period where, crisis and things like that. If the payout ratio is too high, it's very likely that they are gonna decrease the dividend or cut the dividends, okay? And let's see dividends. We have J.P. Morgan 4.25%, Bank of America 3.32, Citigroup very high, 8.48 at the moment. When you see something so high, you have to be careful. It means that it's very likely that they are gonna cut this dividend, okay? Now, and Wells Fargo 4.85. Now we have a payout ratio. Now the problem is that this payout ratio here is from previous years, okay? Now with this 2020 problem, this payout ratio is gonna go very high, okay? Because earnings are less usually, you have more losses, and the dividend is still the same, okay? So it's a ratio that means that it's gonna go higher. Probably for Citibank is gonna go pretty high, okay, pretty high. This dividend right here, well, probably is the most likely to be cut or reduced, okay, because it's very high. Let's see how it goes. Anyway, payout ratios for previous year, they were pretty honest. Not good. Wells Fargo was already at 50% of payout ratio before the crisis. Now it's not gonna be good, okay? It's not gonna be good. Pay very attention to Wells Fargo, and let's take a look at valuation, guys. 5 years average book to value and the current book to value, okay? So that we can see the discount that we get in the market right now. We have a discount which is a minus 15.38% for J.P. Morgan, minus 20% for Bank of America, Citigroup minus 37.50%, and Wells Fargo has been completely, well, destroyed in the market, okay? The market doesn't like Wells Fargo, and I don't like it neither, okay? I told you, the worst of them 4. Minus 60%. 5 years in terms of PE ratio. Let's see. We have 5 years average and the current to see the difference. Okay, so we have for JP Morgan a minus 23.44% discount, minus 43.21% discount for Bank of America, minus 44.7 for Citigroup, and minus 31.50 for Wells Fargo. Let's see now the earnings, how earnings were previous to this crisis, okay? And JP Morgan, guys, is the only one that had constant growth, okay, before this crisis, both for revenues and earnings, okay. So very positive. J.P. Morgan, in my opinion, as I have already told you in another video about 3 stocks that I like, J.P. Morgan, in my opinion, is the best in the bank industry, okay, is the best stock to buy in the bank industry, okay, my personal opinion. Bank of America. Bank of America, we had a peak in 2018, and the revenues and earnings, both of them, they didn't grow in 2019. Okay, so now 2020, they're gonna be even worse. Citigroup, well, pretty constant in terms of revenues, but here in 2017, they had a problem with costs and things like that. Earnings went negative. Okay, so when you see that, this is not something that the market really likes. In fact, if you see, Citigroup is one of the only banks, major US banks, that had never, let's say, come back from the 2008 financial crisis. Okay, if you look at the share price, if you look at the graph, it's clear. Okay, it's pretty clear. While Wells Fargo, guys, we have actually earnings that peaked in 2017, and they are slightly going down. Okay, that's how it is. So the top performance here is J.P. Morgan. Okay, is J.P. Morgan. Be careful about Wells Fargo. Be very careful about Wells Fargo. It is not very diversified, and if a crisis in loans and defaults are gonna increase, is gonna be hit. Okay, probably of them 4 is the one that is gonna be hit the most. And also return of on assets just 0.64%. Okay, it's not very good. So this is the end of the video, guys. I hope you find it interesting, and leave me a like if you find this video interesting, and subscribe to the channel. Leave me a comment below, tell me which one of those 4 stocks you prefer and if you own some of them. Okay, so see you in another video, guys. Have a wonderful day.